knew how much money they had on a loan. And the next question was, have you ever thought of financing the purchase for the buyer? And they go, oh, no. Have you ever thought of selling it yourself, going what we call FSBO, for sale by owner? That was one of the questions. You find out the people's motivation. It's terribly important. And if they have huge amount of equity, say the house is worth $500,000, and they only owe 50 grand on it, and they've been there, 25 years or something, and they're moving in with their kids. Are you going to be buying a house? No, we're going to be moving in with the kids. What are you going to be doing with that money? Probably put it in a series of CDs. Okay, and then you can move into owner financing. And if they say, yeah, on a CD you're going to get 4.5%. I can give you 6% if you do owner financing for the buyer. And by doing that, you make the piece of pie of the buyers much larger than it was before. Okay, in other words, it opens it up to more buyers that normally wouldn't come look at that house if you advertised it as owner financing. So why would people need owner financing?
Because it's better than the banks?
Yeah.
They can't qualify.
Yeah, they can qualify.
They're what?
Yeah, same thing, I'm sorry.
Okay.
They can qualify for
Easier qualifications, easier for the buyer to get into the house. Less restrictions.
Okay. It's cheaper as well.
Yeah.
There's no appraisal fee. There's no points. There's no drawing fees. There's none of that crap. So, when I used to be actively working all the time, which those of you know me know I'm not, I'm just kind of, Kyle helps me on. When I'm on a listing presentation, before I even got to the market analysis, I asked those questions. And I asked them beforehand in the pre-listing package I'd sent out to them, dropped off at their door, nowadays email, and on the phone when I was first qualifying and first talking to them, I asked those questions. So I do it 3 times. Okay, because I really want to know their motivation. So if they're in a situation, I'm dealing with my computer, Kyle. Once you find their motivation, owner financing comes into play. Now, historically, I've had my license a long time. Kyle said I had it during the Depression, and I haven't had it that long, but I've had it now. How long have I had it?
Since the 60s?
50 years.
That's right. You don't have to. What did you
I was
say?
a
You
kid.
don't have to renew your license.
I don't have to pay anything for it anymore. So I grew up on owner financing, and it's a marvelous tool. You just need to understand it. That's it. Okay. There's nothing mysterious about it. People say, well, people don't owner finance anymore. Sure they do. I sold an acre in town, that was owner financing. Sold a triplex, owner financing. Sold 6 units, owner financing. I sold little 2 double duplexes, that was owner. So investors use it a lot
This is
because they
all
know it's a
recent.
great tool.
Yeah, all recent.
They know it's a great tool because if you're getting that instead of putting it in a CD, you'll make an extra percent probably. Because usually owner financing is, it just depends. When the market is good, then it'll be higher than the bank rate. If it's a shitty market, it'll be 1% or 2% lower than the going rate.
So right now it's higher.
It's all negotiable, cyclical, okay? But it can be a wonderful tool for you in your toolbox with the right people.
Would this help with, a lot of people that have 3.6% loans like I do, and I've had it for over 10 years. There's a lot of equity, and they can assume some of those loans, and then, is that a good tool now?
Yeah, we'll get into that.
Oh,
That's
okay.
called a wraparound or
Okay.
second assumption subject to. It goes past the scope of this form, but we'll talk about that because that's how I bought a lot of properties and sold a lot of properties, exactly what you're talking about. And most people won't ask the seller. And I ask them, why not? Well, why would they want to do that? So you're making a prejudgment, and you should ask the damn questions.
So they probably don't even know that exists.
Correct,
And you're opening the door to like, I didn't know I could do that.
right. So everybody's not going to do it. It's a small percentage that do. But if you put together 2 other deals a year, on the average commission nowadays, what is the average? 10 grand or
Oh, yeah,
whatever.
it should start
When I used to do it, used to be, when I started, it was $500 a commission. But so it's another 20 grand in your pocket just for asking one question every time you go talk to a seller. But I mean, if it's a foreclosure or a short sale, of course you're not going to ask that question because they have no equity. So you're not going to do it. Somebody bought the house 2 years ago on an FHA loan or VA, they're not going to have the equity to do something. Unless they're losing the house and you want to do something and say, hey, what if I had somebody pay my commission and then gave you a note for the balance due in 2 years? Would that work for you? And I've had people go, yes. So, okay. Then I call one of my investors and say, okay, now if they call a loan, you're going to have to pay it off, but I got you 2 years in this house for paying me and not them in notes or a note due in 2 years, whatever. You can negotiate all those terms. Nothing is set in stone. Okay, because it gets the seller out of their trouble, out of their problems, and it puts commission in your pocket. And then you still got a seller as a client that within a year or two will probably buy, and a buyer that is going to keep coming to you to find deals. Back a number of years ago, we had these things called foreclosures, bank-owned properties, and short sales. I was in the middle of that, did a lot of business during that time period. I worked with banks, sold their properties, and short sales. And some of those buyers just fell on hard times. They lost a job for a year, then went back to work, but couldn't get caught up, and it was better just to do a short sale or turn it over to the bank and start from scratch. And a lot of them had perfect credit other than their house. And those are people that can use other financing with the right seller. Some sellers will say no, but others you can go to them and say, look, the only thing they were behind on was their house. They kept their car payments up, insurance, everything else is fine. And they've got a chunk of money to put down. Will you finance it for them for 2 years to let them get on their feet? And I've had people go, yeah, okay. Because people always say, well, what happens if they don't pay? Well, you foreclose. And I've had people say, well, do I have to give their down payment back to them? No, you don't. It's yours. It's in your pocket.
And then you could just do it all over again,
And I've had that happen.
just like banks do.
Yes. So, is that enough to pique your interest a little bit?
Yeah.
Okay, let's get started on this now. All right, so this is a basic form. It's a car form. And this one I just kind of did it real quick. So the top part, just like, and what was this one printed? 622. So there'll probably be a new one.
Oh,
Now that they've done everything else, attorneys will be bored, so they'll decide that this isn't good enough and come out with another 4 pages or some damn thing. The original one used to be half a page. So, and the purpose of it is to give to the title company because they will draw the note and deed of trust. And they do it from this form. Okay? Okay. So it's real simple. Number one, you put in the loan amount. Okay, so on this one I put in $400,000. That's the loan, not the purchase price, the loan. This is only about financing, it's not about terms of sale. That's on your RPA.
So let's say the house was sold for $465,000. So
Okay.
they give a $65,000 down payment.
Mhm.
That's why the loan is only $400,000. Oh,
Or if the, if it was $600,000 and they put $200,000 down. Okay, so it's, and it's pretty simple. Interest at, I put in 6%. I have a lot of sellers that would go at 6% right now. Because they're not gonna get 6% on their, well, hell, I don't know what CDs are getting nowadays anyway, but
Probably a little bit.
4.5, 5 maybe,
Wow.
5, okay. And then on this one, I set it up as interest only. You can put whatever payment you want in there. Okay, you can go to your, get your HP calculator or, online and figure out what the payment would be for amortization for 30 years, 20 years, 5, whatever you want. Okay, but a lot of owner financing sometimes is set up on short-term ones. A lot of them are set up interest-only payments.
So they're not paying that loan down at all.
So it's not even going to the principal.
You're
Now, how
keeping
does
your
that
payments
benefit?
down.
Oh, it keeps your payments. Okay. Now, where do you have it on here that it says that?
Right there on
Where is it?
item number 1.
Principal, interest, payment, maturity items.
It says principal and interest, so those 2,000 are going to the principal and interest?
Well, yes, but in this case, it's only interest only.
Interest. How do you know? Does it say there, interest only?
Oh, because
No.
you didn't check principal.
You don't have, that's not part, it doesn't say that in any of the note and deed of trust.
How would the client know then?
Because
those
they
2,000
negotiated it up front.
Oh,
It's in your purchase agreement.
Okay.
You negotiate the terms
In the purchase
in the
agreement.
purchase agreement. That's the purchase. So I say, financing is, the apple is the purchase agreement. This is an orange.
Oh, okay.
Don't get them mixed up. You refer to this, and the title company, Alicia, who I always use, she says, "What's your terms?" And I said, "I'll send over the financing and then." Okay, no problem. It's got everything in. So right there, interest at 6%, payable at approximately $2,000 a month. Balance due, and I thought I put in there. Anyway, you put in when it's due. In this case, I was thinking 5 years. Somehow I didn't get in there.
Where do you write that? In 5 years?
Where it says balance due in
Okay. In 5 years?
whatever,
Okay. Whatever the term you had on the.
whatever this buyer and seller agreed to.
Okay. Okay, so what?
I've done them as short as 6 months. When I buy flips, I do them for 6 months. In some cases, I have lump interest due in 6 months. I don't make any payments during the 6 months. Other times, the seller says, "Well, I want something each month. I need $800 a month." It's okay, fine. Then we just go to an amortization schedule at the end and find out what is interest and what is principal. Okay, so that's part of the purchase agreement, and an addendum on there, and then you mark the box for seller financing on the purchase agreement, and then this below. Okay. Loan application. It's up to the buyer and seller if they want to give one. The old cowboys up in Sonora, they all knew each other and they didn't give a damn. So, I mean, there was none of it, I wrote up one on a napkin in a bar and went over to Jack at the title company and said, "Here's the deal. It's between Fred and Joe." And he said, "Okay, I know them both. I'll have them come in, bring in the stuff, and I'll prepare the docs. We'll close next week." Slam dunk. Okay, nowadays, since attorneys decided that realtors are stupid, that's where all these damn forms came from. So, realtors did not create these.
I'm sure we.
Yeah.
I'm not going to get on a high horse about attorneys, but attorneys think realtors are the dumbest things that walk on the earth. That's why we've got multiple pages of everything instead of the old single page for each one. And they don't give us any space to write anything in anymore. Okay? So, get off that horse. So if you want to do a loan application, that's fine. If you don't, it's up to the buyer and seller. Okay? Credit documents. Number 3, extension of credit will be evidenced by a note and deed of trust is what I marked because that's the simplest basic that people understand. So you know what, all of you have loans on your houses or? So you know that there's a note and there's a deed of trust, correct? On your head.
Yep.
Okay. So the note says, I promise to pay, right? The deed of trust is the security. It says all the horrible things that the lender will do to you if you don't make your payments. That's its only purpose. Okay, so so I marked note and deed of trust. Kathy was talking about, if I have a loan and want to sell, can I put a second or another type of loan on it? You can use also what's called an all-inclusive or a wraparound, which I like to do on all my flips. But the problem is there's a due on sale clause on almost every loan written by a bank.
What is that, like an extra piece?
What a due on sale clause means is that if you sell the property, you have to pay them off.
So in other words, if there's an existing loan on the property, if that lender finds out that the property has sold, that previous loan is called due. So it's all due.
See, I
The
can't,
balance.
I just can't come to you and say, I'll take over your payments. Here's the money, I'll take over your payments, okay, get out. And you sign the house over to me. You can't do that anymore. Used to be, because it was called subject to the existing loan. So you've got subject to and you've got assumable. The only assumable loans really
VA.
are VA, and it has to be a vet. Okay.
Sometimes.
You can do a subject to and a VA, but the seller, then his entitlement is gone. He can't go buy another house on a VA unless it's formally assumed. But a vet can formally assume another vet's loan. Mine is at 3 1/4. So if I sold it now, I would have the vet go get secondary financing, give me a down payment, go get a second somewhere. I want my cash, and then assume my loan.
Unless they have the cash.
Okay.
To
So on
take
an all-inclusive or a wraparound. Oh boy. Let me come back to that. That gets,
It's situation by situation.
it drives people nuts. So anyway, okay, so let's go to the next part. The following terms apply only if checked. Seller is advised to read all the terms, even those not checked, to understand what is or what is not included and the consequences thereof. So number 4 is a late charge. Most loans have a late charge. You know, after 15 days, usually 6% is pretty standard in the industry. Balloon payment. So on this one, that's where I put the balloon payment. I forgot to put in the 5 years, but at the time the balloon payment is due and the notice to be paid off, it'll be $400,000. That way you know that there was no principal paid down. Okay. See, the loan is for $400,000. Interest rate is 6%. Okay? So what's 6% of 400,000? Anybody? Kyle doesn't know. No, come on. Don't use your
I
calculator.
don't know.
What's 6 times 4? Come on, Kathy.
24,000.
6 times 4 is 24.
24,000.
24, okay.
Okay, divided by 12.
It's 2,000.
That's what the payment is. So it's interest only.
Oh.
That's how we get the interest. So anyway, so that the balloon payment is that. Now, prepayment penalty on some loans that you get, if you're a bad buyer and have bad credit, a lot of times there'll be a prepayment penalty because the lender is loaning to somebody that is not really good credit. And if you pay it off soon, they want extra money. And that is what the prepayment penalty is. Okay? Now, investors do it sometimes because the reason investors do a lot of owner financing is it's also a tax break.
Oh.
because all your taxes aren't due at the time of sale. They're spread out over the term of the loan. So it's another advantage that investors talk about, but homeowners don't, and agents don't, because they don't know that. Okay, so say you have an investor who has a rental, and they've had it 20 years, and it's paid off, and they say, okay, I want to sell this. Okay, well, what are you going to do with the money? Well, we're going to help the kids with college, and then we're going to put the rest in a CD or whatever. They're a perfect example for owner financing. Because they get a chunk of cash, pay taxes on it, and then the balance will be, they'll be paying taxes annually on what they're receiving on the owner financing.
Rather than the lump sum.
Correct.
A lot less expensive.
Mm.
Correct.
And they're paying it over time rather than all at once.
Correct.
Big
So,
difference.
okay. Due on sale. So there's a due on sale clause, as Mark. You want to make sure that's there, because when the property is sold, if there is no due on sale clause and I buy your property and finance it from you, then I can go ahead and sell it again to somebody and not pay you off and use like a wraparound or something else. So I make some money and I don't have to pay you off. But if the due on sale clause is there, then I would have to pay you off when I sell it. Does that make sense?
Mhm.
Okay. Request for copy of notice of default. You can mark this for homeowners. Investors I don't worry about too much, but homeowners, if they do it, then I have this. And that means that if you have somebody collecting the money for you, like a trustee or something, instead of you getting the checks each month, if they miss payments, you want to be notified. Okay, and if it goes to foreclosure, you want to have that notice.
As an owner, we want to.
And then request for notice of delinquency, again, that's notice between the two. Tax service, the same thing. That means that buyer and seller are notified each time the taxes are paid. Title insurance, absolutely, absolutely. Hazard insurance, you bet. Proceeds to the buyer. In some instances, with owner financing, there's proceeds to the buyer. And I don't want to get into that because it's so uncommon. It's more confusing than anything else. But that's if there's other financing involved and cash thrown into a pot. And anyway, sometimes that's how we as realtors do it.
But who pays for taxes is following the agreement too, right?
Pardon?
Property taxes, that's always
Yes.
part of the agreement as well?
Well, no, because when you buy a piece of property, you're obligated to pay taxes.
Okay, so then the title changes and then they automatically know they have to.
So I don't really usually worry about that box.
Okay, and if that goes delinquent, then how do you deal with that? Is that also
Foreclosure.
foreclosure?
Well,
Same thing?
there wouldn't be like a
Tax sales are way out in the future. They don't
Right.
happen in a year.
That's true. Takes a long
They take a
time.
long time. So
Yeah.
you have the option of foreclosing.
Do it before the county takes it, for sure.
Well, there's people that bid on tax sales. I got a client that does, and he never gets clear title, and it's a mess. You have to file Liz pendants and all kinds of stuff to sell it. And there's only one escrow officer with First American, and she's in Southern California that'll do them. So, okay, negative amortization, deferred interest. We used to have these adjustable loans years ago that were neg-am, we call them. And the interest rate would be one thing, but your start rate on payment would be lower than what the actual interest rate on the loan was. So your payments could be $200-300 less than what they should be. And so that negative part kept being added $200 or $300 a month to the amount of the loan. And that's what's called negative amortization.
Does that still exist? Probably not, right?
Pardon?
Does that still exist?
I don't know.
Or
of
it's
any.
not too common?
Nobody looks for me. But see, like, when I was in Walnut Creek in 78, 79, 80, my brother-in-law and I bought a couple of places at 22%.
Oh,
Yeah.
And I worked with a lot of business people that were city fathers of Walnut Creek. I'd get in my office, I go, okay, it's 22%. And they go, God, I don't want to pay, you know. But we're talking like $150,000, $200,000 houses. So I'd say, John, what do you expect is going to happen if the interest rates go all the way down to 16%? Well, shit, the values that go through the roof. Fine, sign here.
Press hard.
They just answered the question.
Yeah.
What do you think's going to happen if it goes all the way down to 16? Well, the values will shoot through the roof. Fine, sign here. And they would. Because they were business people and they saw the advantage. Okay, same thing with NAGAM. But they have to know what they're doing.
Oh, yeah. A lot of people are just the common source of it, they lost their.
Right.
And it was awful. Help, it assisted in.
Well, there's a lot of fraudulent lenders.
Like the
going around
arm loan, yeah.
Okay, I'm going to skip over 15 right now. Then tax identification number. When you go to escrow, just like with the bank, you have to give them your social and all that kind of crap because stuff is reported. Okay, so that's just normal. Other credit terms and conditions, you can see that our car attorneys give you a whole bunch of space to write stuff in. You know, what, a line and a half, that's it. Because again, they think we're as stupid comes. And they don't want us to write anything in there. They want to do all the phrases for us. Honest to God. And then want to sue us when we mark the wrong box. Okay? No, that's, anyway. Recording. The documents will be recorded. On a note and deed of trust, they always are. Okay? Junior financing. That would be if there's a second back behind the first or other things or things. And then senior loans and encumbrances on number 20. You list if there's an existing loan on the property. Because if you do owner financing and there's an existing one, it would be a second or a third or whatever. Okay, or a refi. And so you list what it is there. And then there's a spot on here if you want to list the buyer's occupation and all that kind of stuff, they can. And then the rest is just kind of boilerplate, be careful stuff. And then the last page is, I don't really get concerned with it. Like I have a couple investors that we had problems, but because of the under Dodd-Frank, which is a bill. Anyway, seller finances only one property in any 12-month period, and the seller is a natural person, a trustor in the state, he's not a contractor, et cetera, et cetera. So you can read through this and find it's just extra reading, but everybody needs to initial it. Okay? So now we go to the fun stuff. Kind of what Kathy was asking. And how I bought my flips.
So how many flips did you buy?
A few, not a lot.
Was it stressful, like when you get the seller financing and then how, did you have to pay off right away when you fixed it and sold it, or how did that work?
On mine, I did them all for 6 months, the financing. Because I could have the work done usually in 2 months, and if the market was active, sell it within a couple of months.
Oh, because you have time to work it out, see.
And I didn't go to people that were desperate. Those I sold to other people. And that's just kind of, I guess, because I'm a nicer guy or something. But so all the ones I did basically, one I got a bank loan. Yeah, for the full amount. Because I got a good price on it, needed a lot of work. And the lender kept asking me for business. So I told him, I said, if you can get me this, I'll get you a couple other loans. By God, he got me it. So that was when prices were, what did I get that for? 200.
$200?
200, no, 200,000. And so I bought it for 200,000 and I put 50 into it and I sold it for 350 because the market went fucking crazy. But he needed all his money because I sold him a house. Where was it? It was in Riverbank. It was a nice big house in a pool and spa and all this. And it was like 500,000. So he needed that money to put down. So that's why I got that one. Other ones I've usually put 50 or 60. And then, because I know I'm going to have to put anywhere from 15 to 50,000 into the house and then sell it. And my partner and I did half a dozen that way, and it worked well. So we put that money down, and then each one of those had an underlying loan. And the seller has to keep making payments on that loan from the payment that I gave them. Okay, so Roberta's, I don't know if you remember Roberta. She had a little Dodge pickup truck and a little tiny Airstream, and she was a ski patrol, but she was pushing 80. Anyway, I got to know her, and she ended up in a care home, and I worked with her kids, and so I bought the house for how much? I think it was $275, and she had a loan of about $100,000. So I gave the family $50,000 and a note for the balance due in 6 months. Then we went in, cleaned it up, and then sold it. We put about 50 into hers, maybe 60. And we averaged about 60,000 profit on our flips. So I wanted that much, otherwise I didn't want to do it. And other ones I passed on to other investors. But so on this form, where it says number 15, all-inclusive deed of trust. And then also it's back on the other page. This transaction includes an all-inclusive or wraparound, which most people call them. That deed of trust or contract shall provide as follows. In the event of an acceleration of any senior encumbrance, the party responsible for payment or for legal defense is the buyer or the seller. That's negotiable between buyer and seller upon the time of the contract. Okay? Or is not specified in the creditor security. If it's something that's subject to, you don't have to worry about it. If it's a loan that needs to be assumed and has a due on sale clause, you need to mark who's responsible. Because if the bank calls the underlying loan, somebody's got to cough up the money.
Would be a buyer. It should be.
It depends on which box is marked.
Shouldn't it be the,
That would be marked as a buyer, I would think.
That's when this becomes really part of the negotiating with the purchase agreement. It should be in the purchase agreement as well. But then you make sure it's in this. So on mine, I always say, if they call this, you're going to have to pay that loan. And they just go, oh, okay. Here's the thing, if I'm only putting $50,000 down and
as a
getting
buyer,
into the property as a buyer, I don't want to be responsible for that underlying loan if it's called. Because I've already given you a note for $400,000. Yeah, there's an underlying note at $200,000. You're responsible for that, not me.
Okay.
And sellers go,
See it now.
well, what if they call it? Then you got to cough up $200,000. What if I don't have it and it goes to foreclosure? Then I'll sue your butt. So anyway, that's this form. So does any of this make sense?
It does. I like the fact that there's so many.
Yeah, I like,
Wait.
Can you explain the wraparound one again?
Okay. So we've got okay. We use Kathy's again. Her house is the loan on her house is $200,000. Okay, so it's $200,000.
Thank you, Steve.
Okay, and I'm going to buy it for $625. Okay, so if I pay $625 minus $100,000 down payment, then I've got a new loan to her wraparound of $525,000.
The $100,000 is what?
$100,000 is down payment. Okay, and then so if I give $200,000 or $100,000 down on Kathy's house with $625, then there's $525,000 I got to figure out, right? So I'll tell her, okay, I'm going to give you a note for $525,000. And I'll do it at 6%. amortized for 30 years, whatever that payment would be, okay? So that's the big, inside that is this 200,000. Now, I'm only making one payment to her, so she has to continue making the payment on her loan. So let's say her payment is $1,500. She has to continue making that payment. But I'm going to give her payment. Anybody? How much would 6%? 525,000.
2,000 or more.
525?
6%.
3,500. How much?
31.
It's not 31,000 a month.
Oh,
Divide by 12. Okay. Well, yeah, okay. Just say I'm paying her 4,500 a month. Okay. So that's 525,000, 6%. I'm paying her a payment a month, 4,500 a month. Okay. Out of that 4,500 a month, she has to make that $1,500 payment.
yeah, I wish she had a whiteboard.
We should give some more.
Yeah. We should have
So
brought it out.
this
We don't really
loan
have
is
one.
called a wraparound.
This is gold.
because it wraps around the existing loan. But she is still responsible for making the payments on the original loan that she did when she bought the house.
So the payments that you make,
She is in it.
Yes,
She's not living in the house.
only to her. I don't even know who that lender is half the time. I don't care.